Okay, so here's the question I get asked all the time. This strategy looks great in backtesting, but does it actually work in the real world? Well, I've got your answer. 14 months of live forward-tested results on the SPY Holy Grail version 1 strategy, not a backtest, not simulated. This is what actually happened in real market conditions with real volatility, including the tariff shocks. The short version, a CAGR of 32.76% against SPY buy and holds 20.19% with less than half the drawdown. We're going to break down every single number today, and I'm going to explain exactly what each one means in plain English. Let's get into it. Before we go anywhere, the disclaimer: nothing in this video is financial advice. These results are for educational purposes only. Past performance, even live forward test performance, is not a guarantee of future results. The forward test period runs from March 2025 through April 2026, and it reflects the live application of a strategy that was designed and locked in before that period started. This isn't someone fitting a strategy to data they already knew. The strategy was built, published, and then we watched what happened. Alright, so what exactly is the SPY Holy Grail version 1? It's actually not one strategy, it's five. Five independent trading systems, all focused on a single instrument, SPY, the S&P 500 ETF. Each sub-strategy has a different personality and trades at different times. They're called the volume reverter, dip surfer, wave chaser, EMA cross, and RSI cross. Now here's the key thing to understand. Because these five strategies can each have positions open at the same time, the combined exposure can exceed 100%. In fact, the average exposure over this period was about 119%. That means on average, roughly 20% leverage, borrowing a little to be slightly more than fully invested. For comparison, the benchmark is the simplest strategy imaginable. Just buy SPY and hold it. 100% in, never move, reinvest dividends, no thinking, no timing, no leverage, just the market. This is the right benchmark because the Holy Grail trades SPY too. We're asking, can we do better than just owning the thing by being smarter about when we own it? Now let's walk through the numbers. I'm going to explain every single metric here because they all tell a different part of the story. CAGR, which stands for Compound Annual Growth Rate, this is like your average speed on a road trip. If you drove 600 miles in 10 hours, your average speed was 60 miles per hour, even if you were faster some hours and slower others. CAGR tells you the consistent annual growth rate that would have gotten you from start to finish. Holy Grail, 32.76%. SPY buy and hold, 20.19%. Big advantage to the strategy: max drawdown. Imagine hiking a trail that goes up and down. Max drawdown is the deepest valley you walk through, the worst drop from the highest point you had reached before eventually recovering. Holy Grail's worst drop, minus 7.62%. SPY's worst drop, minus 16.46%. That's more than twice as bad. We'll look at exactly when that happened in a minute. It was April 2025 and it was dramatic. MAR ratio. This one's simple once you get it. It's just your annual return divided by your max drawdown. It answers how much return did you get for each percent of pain you had to endure. Holy Grail, 4.30, meaning for every 1% of drawdown, you got back 4.30% per year in return. SPY, 1.23. The Holy Grail is delivering about 3.5 times more return per unit of risk. Sharp ratio. Think of this as measuring the smoothness of your ride. A high Sharp means you're making progress without a lot of jarring volatility. A low Sharp means you're getting bounced around. Both strategies show positive numbers, which is good, but the Holy Grail at 1.75 versus SPY 0.97 means a meaningfully smoother ride for a better destination. Sortie-no ratio. The sortie-no is like the Sharp, but it only penalizes you for bad volatility, the downside swings. It doesn't count the upswings against you because who complains when their account jumps up? Holy Grail, 3.07. SPY 1.62, again a clear advantage. Ulcer Index, love this name, right? The Ulcer Index combines how deep your drawdowns were with how long they lasted. The longer and deeper the wound, the higher the score, and lower is better. Holy Grail 2.57, SPY 3.69. Fewer ulcers with the strategy. Win rate, profit factor, and average exposure will cover on the trade statistics slide. But just note, 77.08% win rate for the Holy Grail versus 66.67% for SPY. Here's the picture version of those numbers. Starting with $100,000 on March 3rd, 2025, SPY buy and hold ended at $121,038, a 21% total gain. Very respectable. The Holy Grail ended at $139,098, a 39.1% total gain. That's an extra $18,000 on a $100,000 account in just over a year. And you can see in the chart that the Holy Grail line generally stays above the SPY line throughout, with less dramatic dips. This is where it gets really interesting, and this is why live forward testing matters. In early April 2025, specifically April 2nd through 4th, there were major tariff announcements that hammered the market. SPY dropped from about $95,000 in account value to $85,000 in just 3 days. Then it kept falling. By April 7th and 8th, SPY had hit its trough, down 16.46% from its peak. That's the kind of move that makes your stomach drop. That's when most people panic and sell. What happened to the Holy Grail during those same days? Its worst point was a drawdown of 7.62%, less than half. Not because it predicted the crash, no strategy reliably does that, but because of how it's positioned, multiple short duration trades, rules-based entries and exits, and exposure that naturally reduces when conditions don't meet its criteria. Then on April 9th, there was a 90-day tariff pause announcement. SPY gapped up hard, and the Holy Grail, because it was already positioned to be active, snapped back near break-even within 2 weeks. By April 22nd through 28th, the Holy Grail was actually above its starting equity from March 2025, up 0.05%. SPY was still down 7.3% from where it started. I want to be clear, this is not a market timing system in the crystal ball sense. It doesn't know what's coming, but the rules that define when it gets in and out happen to create a natural buffer during that shock. And that's the real-world value of a strategy like this. Here's one of my favorite ways to visualize strategy performance. This scatter plot has max drawdown on the x-axis and lower is better, so you want to be as far left as possible, and CAGR on the y-axis and higher is better, so you want to be as far up as possible. Upper left is the ideal zone. More return, less pain. SPY lands at the lower right, 16.46% drawdown, 20.19% return. Holy Grail lands upper left, 7.62% drawdown, 32.76% return. Visually, it's not even close. Let's get into the actual trades because this is where strategy becomes concrete. Over the 14 months, the 5 sub-strategies executed a combined 48 trades. That's roughly 3 to 4 trades per month. Not hyperactive day trading, but not passive either. Win rate, 77.1%. That means 37 of 48 trades were profitable, only 11 were losers. Now, a high win rate alone doesn't make a strategy good. You could win 90% of the time and still lose money if your losers are huge. So we need the next number. Profit factor 3.96. For every dollar lost on losing trades, the strategy made $3.96 on winning trades. That's strong. Compare that to SPY's 3.61. Also good but trailing. Average win plus 1.84%. Average loss minus 2.05%. So wins and losses are roughly similar in size, but you're winning 77% of the time. Expectancy plus 0.95% per trade. This is the single number that summarizes all of the above. On average, every trade you take is expected to return about 0.95% on the deployed capital. Across 48 trades, that compounds nicely. And one more, average winning trades lasted about 11.4 days. Average losers lasted about 5.7 days. The system cuts losses quickly and lets winners run. Let's look at the monthly scorecard. because averages hide a lot. The Holy Grail had 9 out of 14 months positive. SPY had 10 out of 14 positive. So SPY actually won more individual months. But look at the months the Holy Grail won big versus where it lost small. March 2025. Bull strategy started negative as markets were already skittish. Holy Grail minus 6.34%. SPY minus 5.57%, roughly even. April 2025, the tariff crash month. Holy Grail plus 4.48%, SPY minus 0.87%. This is the standout month. While SPY was still recovering, the Holy Grail had already bounced and posted a positive month. From May through October, Holy Grail beat SPY in 5 of 6 months. Then in November and December, quieter, lower volatility months, SPY edged ahead slightly. The strategy tends to earn its keep in volatile mean reverting conditions. April 2026 reversed that. SPY had a very strong plus 9.43% month, and Holy Grail posted plus 6.23%. Great return, just not as strong as a straight-up SPY rally. Overall average, Holy Grail average plus 2.07% per month, SPY average plus 1.47%. Over time, that gap compounds into a very significant difference. Okay, now I want to zoom way out. This is a 33-year backtest, January 1993 through April 2026, with the live portion we've been discussing shown separately in amber so you can see where the live data begins. Starting with $100,000 in 1993, SPY buy and hold grew to $2.94 million. That's the power of just owning the S&P 500 for 33 years, 10.69% CAGR. Max drawdown of 55.2%. That's the 2008 to 2009 crisis where you watched your account get cut nearly in half. The Holy Grail Combo grew to $106.5 million. That is 23.35% CAGR, a maximum drawdown of 23.41%, and a 33-year multiple of 36 times what SPY produced. Now, I have to be honest with you here because I think it's important. Those backtest numbers are extraordinary. $106 million from $100,000. That figure deserves your skepticism, not just your excitement. Backtests are built on historical data and markets change. The strategy that worked beautifully in the 1990s tech boom and navigated the 2008 crisis and the COVID crash, there's no guarantee the same edge persists forever. What I can say is that this strategy was designed before the live period started, and the live results are consistent with the long-term backtest character, higher return, lower drawdown, better risk-adjusted metrics. That consistency is meaningful evidence. It's not proof of the future, but it's the kind of real-world validation you want to see. Let me bring it all back together. In 14 months of live, forward-tested results, real market conditions including a significant tariff-driven crash, the SPY Holy Grail version 1 delivered 32.76% CAGR versus SPY's 20.19%, minus 7.62% max drawdown versus SPY's minus 16.46%, a MAR ratio of 4.30, more than 3 times SPY's 1.23, 77% win rate, 3.96 profit factor, and a smooth 0.91 R-squared equity curve. This isn't about getting rich quick. It's about compounding better, risking less, and sleeping at night while still owning the most liquid, most followed instrument in the world. 14 months is not a long time. I want to be clear about that. We'll need more data. Market cycle. But what happened in April 2025, the live tariff shock test, is exactly the kind of real-world evidence that builds genuine confidence. The strategy did what it was designed to do, protect on the downside, and stay engaged on the upside. If you want to go deeper, full strategy details, monthly updates, and the research behind the Holy Grail series, head over to grailwealth.com and join the newsletter. That's where all the detailed breakdowns live. You can also follow along on X at Grail Wealth. I post real-time commentary as new data comes in each month. The mission at Grail Wealth is simple. grow rich, and assemble an interesting life, not just the money part, the whole thing. If that resonates with you, I think you're going to like what we're building. If you found this video useful, hit subscribe. It genuinely helps the channel. And there's a lot more analysis like this coming. I'll see you in the next one.